Hi all, and welcome to this video financial modeling blog tutorial. Today we're going to talk a bit about working capital. In particular, we're going to look at debtors and creditors, otherwise known as accounts receivables and accounts payables. Okay, if you haven't already done so, stop the tape and please read through the blog tutorial at our website at www.videofinancialmodeling.com/blog. If you've done that, then you're ready to go. Let's jump straight into it. Okay, so the first question says you forecast $2 million of sales on credit each year from 2011 to 2015. Your credit terms are 30 days. What is the size of your debtor or accounts receivables in each of 2011 to 2015? Okay, so the first thing we're going to do is we're going to put in year and we're going to go equals the start period, and I'm just going to add 1 to each of these and copyright, so Control R. And I might just do some formatting as well. And the next thing I'm going to do is I'm going to do revenue, and I'm going to call it accruals. Okay, so when we say accruals, usually we mean that these are running through your P&L, but may not necessarily be cash at that point in time. Okay, so we're firstly going to just grab our credit sales, and I'm just going to go F4 on that to lock that cell. Shift arrow across a few times and Control R to copy that right. Okay, I'm going to add in a couple of rows here. The next thing we're going to do is we're going to get our debtors balance or our accounts receivable balance. Okay, and we're going to use a really simple formula here, and it's applicable 99% of the time, so we'll talk about that other 1% of the time shortly, but that's getting onto a bit more of a complicated subject. So all we're going to do is go that times the 30-day debtors and F4 and divided by 365. Okay, and that's going to give us our debtor balance. Now, for this example, we're going to assume that at the start of 2011 we had a 0 debtor balance. Okay, and so let's just talk about this formula quickly. So we're saying that of 365 days, we're going to receive cash for 335 days, okay? And the remaining 30 days of this year, we're not going to receive our cash until the following year, 2012. Okay, so if we copy this formula across, we're going to get a debtor balance of exactly the same for all of these periods. Now the next thing we're going to do is we're going to look at debtor movements, okay? And these movements are going to give us our revenue in cash, okay? So the first thing we're going to do is go equals that minus that, okay? That's our debtor movement from the start of 2011 till the end of 2011. Now you can do it the other way around. You've just got to make sure that you understand the convention. So if we're looking here, we would go equals that minus that would give us our cash for that period in time. And if we've done it right, it should be equal to 335 divided by 365 times that 2. Okay, looks like we've done that right. Now I'm going to change the convention around and go that, take that, and now with that I'm going to have to go equals that plus that, or the sum of those two. Okay, now let's copy that formula across and just take a look what happens. So in the first year, we've got 1.8 million, or approximately 1.8 million revenue as cash. Okay, so cash coming out of the business from our credit sales. Now, the 30-day stub period at the end of 2011, will only be paid out. So this number here will be paid out in this next period. Okay? And because of that reason, if we take this 335 divided by 365 times that, plus or minus this one, we're going to get 2 million for that. And it cascades all the way along. So this debtor balance here is going to be paid out in 2013, and this one here is going to be paid in 2014. This one here is going to be paid out in 2016. So on and so on. Okay, so that is our debtor balance. Now you've got to be careful with this formula, because where this 30 is over, say, the 365 days, so if we change this to 400 days, now our formula is not going to work, okay? So we'd need a different formula for that. I'm going to change it back to 30. Like I said, in 99% of cases, this formula is going to be applicable, okay? And okay, let's go down and let's look at the next question and answer that quickly. So it says you buy services worth $1,000 every year from 2008 to 2011. You have credit terms of 90 days and you start with a credit balance of $250 at the start of 2008. What is your creditor slash account payable balance at the end of 2011? Okay, so let's go and let's put in year, and our first year is going to be 2008. We're just going to add one to that, and I'm just going to format it. You don't need to. And the next thing we're going to do is we're going to go service expenses accruals. Okay, and that's simply going to be equal to, and that one there, the $1,000. And we're just going to copy that one across. Okay, now we're going to use a similar format to the debtor one above. So now we're going to look at our creditor balance, and we're going to go equals this times the 90 days divided by 365. I realize that there could be a leap year and we could have a 366 here, but we're just going to have 365 for simplicity, and we're just going to lock this one in and copy it right. Okay, so there's our creditor balance. Now we could have these as negative numbers and our creditor balance as a positive number. And obviously our creditor balance at the start of 2008 is going to be this number, and I'm going to color it red because it's a unique formula across the row. Next thing we're going to do is put in creditor movements. Okay, and all we're going to do here is we're going to go equals that minus that. Okay, and that's across. Now, if we're moving from 250 to 247 in creditor balances, that means we've reduced our creditor balance, and because this is a liability account, that means we've paid out more cash. So what we need to do here is add these two together, and that will give us how much we've paid out in cash expenses, or let's call it service expenses cash. Okay, so hopefully now you realize that there is a difference between accruals and cash, and also you have a feel for debtors and creditors. If you like this YouTube video, please help us and click the like down the bottom of this YouTube video. Alternatively, go to our website and share through some of the social media that we have at the bottom of the blog post.